Good day, everyone. I'm Professor Leslie. I will be the one discussing the 5.3, the analysis of growth in shareholders' equity growth. Importance of shareholders' equity growth. Shareholders' equity is the heart of company's financial well-being. It's the portion of company's asset that really belongs to its owners, the shareholders. It represents the residual interest in the company after all debts and liabilities have been settled. In simple terms, it's the company's net worth. So why it matters? The understanding how shareholders' equity grows and shrinks over time is vital for investors, financial analysts, and more interested in company's stability. A healthy growth in shareholders' equity signals that the company is generating more value for its shareholders. Conversely, a decline indicate financial trouble. So today we are going to explore not only the concept of shareholders' equity but also how to analyze its growth. Well, discuss the methods, metrics, and factors to consider when assessing this essential component of a company's balance sheet. Our goal is to equip you or us with the knowledge and tools to make informed investments decisions, evaluate company's financial performance, and gauge its long-term financial strength. Shareholders' equity growth analysis is a valuable skill that can guide you or us in the world of finance and investment. So let us dive into the details of its critical financial metric. So before we jump into the analysis, it's essential to establish a strong foundation by understanding the basic of shareholders' equity. Shareholders' equity is also known as the owner's equity or stockholders' equity. It's a critical financial metric that represents the portion of company's asset that truly belongs to its shareholders. It essential it is essentially the net worth of the company. Shareholders' equity is the residual interest in the company after all its debts and liabilities have been settled. Significance on the balance sheet. The balance sheet is a key financial statement is where you'll find shareholders' equity. It's significant because it provides a snapshots of the company's financial health at a specific point in time. Shareholders' equity is a reflection of the company's financial strength. A healthy shareholders' equity indicates that the company has valuable assets that exceeds its obligation, making it more resilient to financial challenges. So this is the formula for calculating shareholders' equity. Shareholders' equity is equal to total asset less total liabilities. This formula is fundamental to understanding how shareholders' equity is calculated. Total assets represents everything a company owns, while total liabilities are the company's financial obligation. The difference between these two figures reveals the shareholders' equity. Oh, the balance sheet is like a financial snapshot of a company at a specific point in time. Understanding the components of shareholders' equity, such as asset and liabilities, is essential for conducting a thorough analysis. Now that we covered the basic of shareholders' equity, let's move on to how to gather the necessary data for analysis. So to analyze shareholders' equity growth effectively, the foundation is laid by gathering the right data and maintaining consistency in data collection. Need for collecting financial statements. The first step in analyzing shareholders' equity growth is gathering the financial statement of the company. These financial statements, including balance sheets, income statements, and cash flow statements, provide the raw necessary of your analysis. They offer a comprehensive view of company's financial performance over time. First, we have a importance of consistent accounting methods. It's crucial to highlight the data gathered must be consistent across different time periods. This consistency ensures accurate comparisons. Using consistent accounting methods and standard prevents distortions in our analysis and provides a reliable basis for assessing changes in shareholders' equity. So, the importance of gathering financial statement cannot be overstated. These documents are our window into the financial health of a company and are essentials for calculating shareholders' equity. Additionally, maintaining consistency in accounting methods and standards is key to ensuring the integrity and reliability of our analysis. With the right data and a commitment to consistency, we can move to the next step of calculating shareholders' equity graph. So now that we have gathered the necessary data, let's dive into how we calculate shareholders' equity. So, as I mentioned earlier, the formula of shareholders' equity is equal to total assets less total liabilities. So, this formula, as mentioned earlier, is the core of calculating shareholders' equity. It represents the net worth of the company, the portion assets owned by shareholders after all obligations are settled. So, here is this example calculation. So let's consider a hypothetical example. So, say we have a company with total assets of $500,000 and the total liabilities of $300,000 for a specific period. So to calculate shareholders' equity is equal to $500,000, which is our total assets, less $300,000, which is our total liabilities. Shareholders' equity is equal to $200,000. So the formula for calculating shareholders' equity is straightforward but immensely valuable. It provides us with a clear understanding of the company's net worth at a specific point in time. In our example, the company has a shareholders' equity of $200,000, which represents the owner's claim on the company's assets after accounting for all obligations. So next, we will explore how to assess the growth of shareholders' equity over time using these calculated values. So now that we've mastered the basic of calculating shareholders' equity, let's delve into measuring its growth. This is where the real analysis begins. So introducing the compound annual growth rate or the CAGR. So to measure the growth of shareholders' equity over multiple periods, we use a power tool called a compound annual growth rate or CAGR. CAGR calculates the annual growth rate considering the compounding effect over time. So the CAGR formula is equal to ending value over beginning value raised to 1 over n less 1 close parenthesis multiply by 100. So in this formula, ending value represents the shareholders' equity at the end of the chosen period. Next is the beginning value is the shareholders' equity at the start of the beginning period. So the end stands is for the number of years in the period. So year over year or YOY growth. So in addition to CAGR, we'll also explore the year-over-year growth. This concept focuses on measuring the growth rate from one year to the next. It's a simpler way to gauge the annual change in shareholders' equity. So the CAGR is a good tool for assessing the growth of shareholders' equity over multiple years, providing us with a compound annual growth rate that considers the effect of compounding over time. In contrast, year over year or YOY growth is more straightforward and looks at the annual change from one year to the next, making it easier to comprehend for those looking for quick insights. So with these tools at our disposal, we can analyze shareholders' equity growth with precision and flexibility. So to put our knowledge into practice, let's take a look at a real-world example. We will explore the financial data of sample company and calculate the compound annual growth rate or the CAGR for its shareholders' equity over the past years. Here I present the sample company. So let's say that we were going to examine the financial of XYZ Corporation, a hypothetical company. Let's take a look at XYZ Corporation shareholders equity data over the last 5 years. So here we have uh, year 2019, 2022, 2021, 2022, and lastly is 2023. Then the shareholders equity is computed and show us in dollars. We have $500,000 for the beginning year, which is for year 2019. So next is $550, $590, $620, $650. So calculating the CAGR using the CAGR formula as I mentioned earlier, will now calculate the compound annual growth rate of XYZ Corporation shareholders equity. So interpreting the results, is it growing or declining? So after the calculating the CAGR, we'll interpret the results to determine whether XYZ Corporation's shareholders' equity is growing or declining. So let's perform this analysis step by step. First, we calculate the CAGR for XYZ Corporation shareholders' equity, and then we will discuss what the results mean for the company's financial health. So, for calculating the CAGR, let's calculate the step 1. So they said that we need to calculate the CAGR first. So we need to determine the beginning and the ending values of the calculation. So in our table examples, so our example at the beginning value is $500,000. It is the shareholders' equity for the year 2019. And the ending value is $650,000, which is the shareholders' equity and in 2023. So we also need to identify the number of years in the period, which is 4 years in this case from 2019 to 2023. So step 2 is calculating CAGR. So now let's plug these values into the formula. Now let's plug these values into the CAGR formula. The CAGR equals open and close parenthesis ending value over beginning value raised to open and close parenthesis 1 over n minus 1 multiplied by 100. So the CAGR is $650,000 over $500,000 close parenthesis raised to open and close parenthesis 1 over 4 less 1 multiplied by 100. So, calculating the CAGR, let's calculate in step 3. So, calculate using the formula of CAGR is 1.3 raised to open and close parenthesis 0.25 less 1 multiplied by 100. CAGR is equal to 6.25%. So, interpreting the results, is it growing or declining? So now that we have calculated the compound annual growth rate, the CAGR for XYZ Corporation shareholders equity, it's time to interpret the results and answer the crucial question: is the company shareholders equity growing or declining? So for the CAGR calculation formula, let's take a review. So we calculated a CAGR of approximately 6.25% for XYZ Corporation shareholders' equity over the past 4 years. So for the interpretation, a positive CAGR indicates growth. So in this case, a CAGR of 6.25% signifies that XYZ Corporation shareholders' equity is growing at an annual rate of 6.25%. So for the implication, shareholders' equity growth is positive sign for the company's financial health. It suggests that the company's net worth is increasing, which can be due to the factors such as profitability, efficient management of assets and liabilities, or strategic financial decisions. So for the conclusions, based on the CAGR calculation, we can conclude that the corporation of XYZ shareholders equity is experiencing a healthy growth over the specified period. This is a positive indicator of the company's financial well-being. So, in summary, a positive CAGR suggests that XYZ Corporation shareholders equity is on an upward trajectory, indicating financial health and an increase in net worth. This growth can be attributed to various factors, and it's a promising sign for the company's long-term financial stability. So this analysis is essential for investors and analysts as it provides insights into the company's financial performance and potentials. Now let's continue to exploration of shareholders equity analysis. So, shareholders' equity growth is not solely dependent on internal financial management. External factors can have a significant impact on this metric. Let's explore some of these external factors that can influence shareholders' equity. First, we have a revenue changes. So when we say revenue changes, fluctuations in a company's revenue can directly affect its shareholders' equity. Increased revenue may lead to higher retained earnings, which can boost shareholders' equity. Conversely, declining revenue may result in reduced equity growth. So next is we have expenses. So in expenses, rising expenses can erode shareholders' equity. Cost management is vital as low expenses contribute to a stronger equity growth. Next, we had a debt level. So debt levels is a company carries affect shareholders' equity. High debt levels can lead to interest payments and in turn reduce equity growth. And lastly, we have a significant events. So events such as mergers, acquisitions, divestitures, or changes in accounting methods can have a profound impact on shareholders' equity. It is essential to consider these events when analyzing growth. So these external factors, along with the internal financial management, play a crucial role in shaping a company shareholders' equity. So when we analyzing equity growth, it is essential to consider these variables to gain a comprehensive understanding of a company's financial health. Next is we were be discussing the benchmarking and comparing equity growth to industry standards. When analyzing shareholders' equity growth, it's not just about looking at the numbers in isolation. It's crucial to put those numbers in context by comparing them to industry benchmarking and standards. So first we have a emphasizing the importance. So Company company shareholders' equity growth to industry peers is crucial. It provides insight into how the company performs relative to others in the same sector. So this comparison helps us gauge the company's competitiveness and financial health. So next is the industry-specific benchmarks and standards. Different industries have their own unique benchmarking and standards. For example, the average equity growth in rate in the technology sector might be different from that in the healthcare sector. So understanding these industry-specific benchmarks help us make more accurate assessments. So by benchmarking a company's equity growth against industry peers, we can gain a better understanding of its relative position in the market. So, are they outperforming or lagging behind the competitors, or is it valuable perspectives as we have been analyzing shareholders' equity growth? So, as we move forward, we will discuss how to use historical growth data to forecast future equity growth, so which can be a powerful tool for investors and analysis for analyzing the data. Future growth forecast. So the past is a powerful predictor of the future, and this holds true when analyzing shareholders' equity growth. So let's explore how historical growth data can help us forecast future growth and why this analysis is vital for investors and analysts. So first we have a historical growth as a predictor. So historical data reveals trends and patterns in a company's equity growth. So by analyzing past performance, we can identify whether the company has consistently grown or experienced fluctuations. Next, we have the importance of investors and analysis. So, for investors, understanding a company's potential for future equity growth is essential. So, it helps us to make them informed investments decisions, assessing the long-term financial health of the company. So, analysts rely on the analysis to provide recommendations and guidance to investors. So, it's critical component of the research. So, by using historical growth data to forecast future growth, investors and analysis can make more informed and strategic decisions. So it allows us to gauge the financial health of a company over the long term, aiding the assessment of investments opportunities. So that's the
My name is Salvacion Taikoa. This is the continuations of Leslie Rubusora report. As we conclude our discussion in analyzing shareholders' equity growth, it's crucial to summarize the key point we covered and emphasize the importance of this analysis. Shareholders' equity represent the total amount of capital in a company that is directly linked to its owner. That is the dollar value of the company. The sum of these components make up the total shareholders' equity. It often considered as a key financial metric, as it represents the book value of the company and reflect how much shareholders would theoretically receive if all assets were sold and all debt were paid off. In essence, it quantifies the ownership interest of the shareholders in the company and can be an important indicator of the company financial health and value. If the company ever needs to be liquidated, or SE, um, is the amount of the would be returned to be this owner after all other debts are satisfied. If the company needs to be liquidated or dissolved, shareholders' equity represent the amount that will be returned to the owners or shareholders after all debt and liquidates liabilities has been satisfied. This is because shareholders' equity reflect the ownership interest in the company and represent the residual claim of the company asset. So, shareholders' equity is a residual value that belongs to the owners of the company after all external obligation has been met. It represents the owner claim to the asset in its fundamental concept in understanding a company's financial health and the potential return to the shareholders and a liquidation scenario. Understanding shareholders' equity. Ang shareholders equity, ito yung nagre-representa ng kabuuang halaga ng puhunan sa isang kumpanya ng kaugnayan sa may-ari nito. Ito ay halaga ng dolyar ng kumpanya na pag-aari ng mga stockholders o may-ari ng kumpanya. Ang halimbawa nito is yung common stock, retained earnings, additional paid in capital, treasury stock, and other comprehensive income. Ito yung pagsasama ng bahaging ito na bumubuo ng kabuuang shareholders equity. Ito ay karaniwang itinuturing na mahalagang metric sa pananaliksik ng kalusugan at halaga ng kumpanya dahil ito ay nagre-representa ng book value or halaga ng kumpanya na nagpapakita kung magkano ang theoretical na matatanggap ng mga stockholders kung ang lahat ng riyan ay mabibenta at ang lahat ng utang ay mababayaran. Ito ay isang indikasyon sa pag-aari ng mga stockholders sa kumpanya at maaring maging mahalaga sa pagsusuri ng kalusugan ng isang kumpanya at halaga nito. Data gathering and consistency. Gathering financial statement and maintaining consistency in accounting method are essential for accurate analysis. Ang data gathering or pangolekta ng datos ay ang proseso ng pagkuha ng impormasyon mula sa iba't ibang pinagmumulan o sanggunian. Malaga ito sa pagsasagawa ng pagsusuri, pag-aaral at pagtutukoy ng mga impormasyon na may kinalaman sa isang tiyak na paksa o layunin. Ang consistency or kabilang banda ay ang katatagan o pare-parehong datos sa impormasyon sa iba't ibang bahagi ng pag-aaral o pananaliksik. Ito yung kung sa pangkahalatan, ang tamang datos ng gathering ay nagkakaroon ng consistency at maayos na datos ay mahalaga sa anumang proseso na pagsasaliksik o pagsusuri. Ito ay nagpapahintulot sa mga pananaliksik sa pagkakaroon ng tamang impormasyon at makabuo ng tumpak na conclusion. Calculating growth with the CAGR or the compound annual growth rate. It is a value tool for assessing how shareholders' equity has grown over time. Ang compound annual growth rate or CAGR ay isang metric na ginagamit upang kauntifikahin ang average ng annual growth rate ng isang investment or proyekto or datos ng maayon sa taong compound interest. Sa madaling salita, ito yung nagmamarka ng kung paano lumalago ang isang halaga o kita sa paglipas ng panahon. Ito yung pagtapos ng mga hakbang na ito yung makakakuha ng percentage na nagpapakita kung gaano kabilis o kabagal ang paglago ng halaga o kita sa loob ng mga taon. Ito ay isang mahalagang tool sa pagsusuri ng financial o pagtutukoy ng potential na kita o pag-evaluate ng investment performance sa loob ng mga taon. External factor. Revenues, changes, expenses, debt level, and significant event and influence shareholders equity. Ito yung tumutukoy sa mga elemento ng pagsusuri mula sa labas ng isang organisasyon, individual o proseso na maaaring makapekto sa pagkakaroon ng impluwensya ng mga desisyon ng operasyon o kalagayan nito. Ang panlabas na salik ay mga bagay ng kondisyon ng kadalasang hindi kontrolado ng organisations or individual ngunit maaari magdulot ng positibo or negatibong epekto ng kanilang mga layunin o aktibidad. Mga halimbawa ng panlabas ng mga salik ay maaaring kasama ang krimiya, pamaalan or teknolohiya, competitions, or pagbabago ng kultura ng mga regulasyon ng mga industry. at iba pa. Ang pag-unawa ng panlabas ng salik ay mahalaga sa paggawa ng wastong desisyon at pag-alok ng estrahiya upang mag-manage o maka-advance ang mga ito. Industriya benchmark. Comparing company equity growth to industry benchmarking provides context for performance analysis. Ito yung isang proseso sa pagkukumpara o pag-aalok ng benchmark o pamantayan sa mga kalakaran ng tagumpay at performance ng isang kumpanya or organisasyon laban sa mga kalahok o katulad ng mga kumpanya sa parehong industriya. Layunin nito ang malaman kung gaano kompetitibo o epektibo ang isang kumpanya kumpara sa ibang industriya. Ito yung mahalaga sa mga kumpanya dahil nagbibigay ito ng konteksto sa kanilang mga resulta at nagpapahintulot sa kanila na malaman kung sila ay nasa tuktok ng kanilang industriya. Nangangailangan na ang pagbabago o pagpapabuti o kung sila man ay matatalo ng kanilang mga competitors. Sa pamagitan ng benchmarking, maaari silang kumuha ng mga idea or best practices mula sa iba't ibang upang makapabuti sa kanilang sariling mga proseso o produkto. Halimbawa ng mga aspekto na maaaring isalaysay sa pamagitan ng benchmarking ay kasama ang kita, kalidad ng produkto, maging ang produkto, pagiging customer satisfaction, at iba pa. Ito ay isang mahalagang bahagi ng pangangasiwa ng negosyo na nagtutulong sa kumpanya na maging mas epektibo at ma-maintain o mapalakas ang kanilang competition sa industriya. Forecasting future growth. Historical growth data can be reliable predictors of a company future equity growth, benefit, and investors and analysis. Ito yung proseso o pagtutukoy sa pag-aanalisa sa pagtaya na posibleng paglago o pag-usbong ng isang kumpanya, industriya o ekonomiya ng mga darating na panahon. Ito ay yung mahalaga sa pangasiwa ng negosyo, financial na plano, pagtukoy ng mga oportunidad at panganib. Sa pagsasagawa ng pagsulong ng hinaharap, maaaring gamitin ang iba't ibang pamamaraan o datos. Kabilang sa kasaysay ng performance, mga trend at mga macroeconomic investigation, consumer behavior, technological na pagbabago at iba pa. Maaari rin itong magamit sa pagbuo ng mga financial projections, strategic planning at pagtukoy sa mga potential na investment. Ang forecasting ay nagbibigay daan sa mga kumpanya at organisasyon na maganda at gumawa ng desisyon batay sa kanilang mga inaasam na hinarap. Ito ay isang malagang bahagi ng pagtutukoy ng mga hakbang na kinakailangan upang makamtan ang mga layunin at masiguro ang tagumpay ng mga susunod na taon. Subalit dapat tandaan na ito ay isang prediction lamang at hindi isang tiyak na pangako. Pangako na maaring hindi inasam mangyayari sa maaring makapekto sa hinaharap. Conclusion. In conclusions, analyzing shareholders' equity growth is a fundamental aspect of financial analysis. It's offered the window into a company's financial health, is competitive in the industry, and its potential for future growth. Whether you are an investor seeking opportunities or an analysis providing guidance as a true understanding of shareholders' equity is a power tools in your financial toolkit. Thank you for your attention, and we're now open for any question you might have. In the conclusion, as we wrap up our presentation, let's briefly recap the significance of analyzing shareholders' equity growth. Shareholders' equity growth analysis is a fundamental tool evaluating a company's financial health. It helps investors make informed decisions and provides analysis with a value insight to guide recommendations. These analyses allow us to understand how a company net worth evolves, whether it's growing stagnant or declining. We encourage you to further explore and research this topic. Understanding shareholders' equity growth and an individual skill for the financial professionals, investors, and anyone interested in assessing a company long-term financial stability.
The analysis of growth in sustainable earnings and the evaluation of PB ratios and PE ratios are topics that involve understanding how a company's profitability, growth, and valuation are related. Sustainable earnings are the core or normal earnings that a company can generate from its operations, excluding any transitory or unusual items that may distort the reported earnings. Nang ibig sabihin, ang mga sustainable na kita ay mga pangunahing o normal na makita na maaaring makuha ng isang kumpanya mula sa mga operasyon nito. Hindi kasama ang anumang lumipas o hindi pangkaraniwang mga item na maaaring makasira sa inuulat na mga kita. PB ratio is the ratio of company's market price per share to its book value per share, which reflects the shareholders' equity on the balance sheet. PE ratio is the ratio of a company's market price per share to its earnings per share, which reflects the net income on the income statement. One way to analyze the growth in sustainable earnings is to use the residual earnings model, which decomposes the shareholders' equity into two components, book value and residual earnings. Residual earnings are the excess of net income over the required return on equity, which is the opportunity cost of investing in the company. Residual earnings growth is driven by two factors, changes in return on net operating assets, RNOA, and growth in investment. RNOA measures how efficiently a company uses its operating assets to generate operating income. Growth and investment measures how much a company invests in a new operating assets to expand its operations. A company can increase its residual earnings growth by improving its RNOA or by investing in projects that have positive net present value. One way to evaluate the PB ratios and PE ratios is to use the abnormal earnings growth model, which links the two ratios based on the expected future growth and residual earnings. Abnormal earnings growth is the difference between residual earnings growth and required return on equity, which reflects the value, creations, or destruction by the company. The model shows the PB ratio is equal to 1 plus the present value of abnormal earnings growth, and PE ratio is equal to 1 plus the product of PB ratio and abnormal earnings growth. Therefore, PB ratio and PE ratio are positively related and both depend on the expected future profitability and growth opportunities of the company. To summarize, the analysis of growth and sustainable earnings and the evaluation of PB ratios and PE ratios are important for assessing a company's performance and value. By using the residual earnings model and the abnormal earnings growth model, an analyst can identify the drivers of shareholders' equity growth and valuation and compare them across different companies or industries.
Good day, ma'am. I'm Aaron Grace M. Ariola. I am the next reporter. I will discuss about to compare companies using price to book and price earnings ratios. You need to understand what these ratios mean and how they are related to each other. Price to book ratio compares the market price of a company's stock to its book value, which is the shareholders' equity on the balance sheet. It means price to book ratio reflects how much investors are willing to pay for each dollar of book value. A high price to book ratio means that investors have high expectations for the company's future growth and profitability, or that the company has intangible assets that are not captured by the book value. A low price to book ratio means that investors have low expectations for the company's future performance, or that the company has impaired or obsolete assets that reduce its book value. Price to earnings ratio compares the market price of a company's stock to its earnings, which is the net income on the income statement. Price to earnings ratio reflects how much investors are willing to pay for each dollar of earnings. A high price to earnings ratio means that investors expect the company to have high earnings growth in the future, or that the company has a competitive advantage that allows it earn above average returns. A low price to earnings ratio means that investors expect the company to have low earnings growth in the future, or that the company faces challenges that limit its profitability. Both ratios are used to evaluate how expensive or cheap a company's stock is related to its fundamentals. Price to book ratio and price to earnings ratio are related by the abnormal earnings growth model, which shows that price to book ratio is equal to 1 plus the present value of abnormal earnings growth, and price to earnings ratio is equal to 1 plus the product of price to book and abnormal earnings growth. Abnormal earnings growth is the difference between residual earnings growth and required return on equity, which reflects the value creations or restriction by the company. Therefore, both ratios depend on the expected future profitability and growth opportunities of the company. To compare companies using price to book and price to earnings ratios, you need to consider the following steps. Choose companies that are in the same industry or sector, as different industries may have different average ratios and growth prospects. Calculate the price to book and price to earnings ratios for each company using their latest financial data. You can use online sources such as Investopedia or Schwab to find these ratios or formulas to calculate them. Compare the ratios across the companies and look for any significant differences or trends. For example, you may find that some companies have higher or lower ratios than others, or that some companies have increasing or decreasing ratios over time. Analyze the reasons behind the differences or trends in the ratios. You may need to look deeper into the financial statements or other sources of information to find out what factors are affecting the ratios. For example, you may find that some companies have higher price to book ratios because they have more intangible assets such as patents or brands, or that some companies have lower price to earnings ratios because they have lower profit margins or higher debt levels. Evaluate the potential risks and rewards of investing in each company based on their ratios and other factors. You may need to consider your own investment objectives, risk tolerance, and time horizon to decide which company suit your needs best. For example, you may prefer a company with a low price to book ratio and a high price to earnings ratio. If you are looking for a value stock with strong earnings potential, or a company with a high price to book ratio and a low price to earnings ratio. If you are looking for a growth stock with stable earnings.
Hi everyone, I'm Maradona Miolarta and this is the continuation of our report, topic 5.4, the analysis of growth in sustainable earnings and the evaluation of PB ratios and PE ratio. So let's give an example for comparing two companies using PB and PE ratios. Let's say that we want to compare two companies in the same industry, such as Apple Company and Microsoft Company, which are both in the technology sector. We can use the following step to compare them using PV and PE ratio. First, we need to find the current stock price, book value per share, and earning per share for each company. We can use online sources to find this data or formulas to calculate them. Let's proceed to current stock price. If we can find the current stock price, we can use this formula to calculate it. current stock price is equal to market cap over share outstanding. But from online sources, we can see that the current stock price of Apple is 170.29, while the Microsoft get its current stock price of 337.31 per share. So let's proceed to the book value per share of two companies. We can use this formula to get the book value per share. Total shareholder equity minus preferred stock divided by shares outstanding. So let's calculate the book value per share of Apple Company. As we can see, the total shareholder equity of Apple Company is 60,274, preferred stock of 0, shares outstanding of 15,647.9. So 60,274 minus 0 divided by 15,647.9 is equal to 3.85. We can repeat the same process for Microsoft and get its book value per share. So 206,223 minus 0 divided by 7,432 is equal to 27.75. From this result, you can see that the book value per share of Apple is 3.85, while the Microsoft get 27.75 book value per share. Next, we need to find the earnings per share for each company. We can use this formula to calculate them. Earnings per share is equal to net income minus preferred dividends divided by shares outstanding basic average. Let's calculate the earnings per share of Apple Company. So as we can see, the net income of Apple Company is 19,881, preferred dividends of 0, shares outstanding basic average of 15,697.614. So 19,881 minus 0 divided by 15,697.614 is equal to 1.27. But earnings per share basic for the trailing 12 months ended in June 2023 adds up the quarterly data reported by the company within the most recent 12 months. The earning per share of Apple Company is 5.98. So we're gonna using the 5.98 as earning per share of Apple Company. So we can repeat the same process for Microsoft and gets its earning per share. So 72,361 minus 0 divided by 7,472 is equal to 9.68. From this result, you can see that the earnings per share of Apple is 5.98, while the Microsoft gets its earning per share of 9.68. After we have obtained all the necessary data, we can calculate the PV and PE ratios for each company. Let's calculate the PV ratio of two companies using this formula. PB ratio is equal to current stock price over book value per share. As we can see, the current stock price of Apple Company is 170.29 and book value per share of 3.85. So 170.29 divided by 3.85 is equal to 44.23. So we can repeat the same process for Microsoft. 337.31 divided by 27.75 is equal to 12.16. From this result, you can see that the PV ratio of Apple company is 44.28 while the Microsoft is 12.16. Let's calculate the PE ratios of two companies using this formula. PE ratio is equal to current stock price over earnings per share. So as we can see, the current stock price of Apple company is 170.29 while the earnings per share is 5.98. So 170.29 divided by 5.98 is equal to 28.48. We can repeat the same process for Microsoft. 337.31 divided by 9.68 is equal to 34.85. From this result, we can see that the PE ratio of Apple company is 28.48 while the Microsoft is 34.85. Finally, we can compare the ratio across the two companies and look for any significant differences or trends. For example, we may find that Apple company has a higher PB ratio than Microsoft, which means that investors are willing to pay more for each dollar of book value of Apple. This could indicate that Apple has more intangible assets, such brands that are not captured by the book value or that investors have high expectation for Apple's future growth and profitability. While Microsoft has higher PE ratio, which means that the investors are willing to pay for each dollar of earnings of Microsoft. This could indicate that Microsoft has higher earnings growth potential in the future, or that Microsoft has competitive advantage that allows it to earn above average return. But both companies have high PV and PE ratios compared to the industry average, which means that they are both valued highly by the market. This could reflect their strong performance and reputation in technology sector, or their ability to innovate, create value of their customers and shareholders. I hope this example helped you to understand how to compare two companies using PB and PE ratios. That's all. Thank you.